Thanks everybody for joining. I'm glad to see my buddy Jeff joining. I'm bummed I didn't get to see you at the at Bitcoin Vegas, but um, but yeah, we're going to discuss the fund strategy at the moment and what we're looking at as far as macro goes. Um, some of the things that we're really looking at right now is some of the digital asset funds that still have heavy discounts to NAV. We are also looking at a few treasury opportunities. So those are things that we're looking at in the future that we're going to continue to continue to promote. Of course, our risk management strategy is moving into U.S. Treasuries and trading Treasuries when we feel like there's a little bit too much volatility in Bitcoin and crypto. So again, myself and Josh were the primary portfolio management team. The way that we work together is I'm looking at risk management, macro outlook, where Josh is looking at fundamental and technical analysis as we're making long-term decisions and then trading around those decisions. And on to the discussion. So first of all, we're going to talk about, I'm going to cover the macro side and talk about what we see happening in both regulatory and policy decisions in the US and globally, and how we're positioning the portfolio to respond to that. And then, of course, Josh will move into Bitcoins and alts and more trend analysis and cycles and dominance factors. So moving right into macro, we of course there's been a lot of drama around Trump and Powell. I personally actually have believed that Powell has done a good job as chairman of the Fed for most of his tenure. The last year has been a little bit off. It's been very easy to predict which raises and cuts due to politics. So we certainly saw that in a lot of 2024. We pretty much got that right in when we expected Powell to cut and how much he cut, and again a lot of it had to do with political timing, and there continues to be more of a flavor of politics in this part of the tenure going into this year. Um, as far as what I'm seeing in fixed income and on the bond curve is that if you look at the natural curvature of treasuries, what we're seeing is that it's coming back to a normal curve, except for the short end. So I don't expect, even if the Fed decides to lower rates in July, which I believe that they will, uh, I don't expect to see the 10-year come down too significantly. But the short end is at risk right now. This is why the short end of the curve, 3 month, 6 month, is actually a higher yield than 2-year, 5-year. And that's very problematic for two reasons. There's a lot of debt and interest rates that are based on the short end. Starting at the longer end, the 10-year is really what drives mortgage rates, and we are experiencing a bit of a mortgage crunch at the moment. If you look at housing prices, housing starts, inventory, uh, a lot of the housing market looks like it did pre 2007, as well as certain delinquencies. Now, we don't have the subprime issues that we had then, but we do have delinquencies more on the lower end of that curve. So the only way to fix that is for the 10-year to actually come down. Now, the Fed doesn't necessarily control the 10-year, but they do control the Fed fund rates, which is the short end. But it does have a driving factor on 10-year rates. So my expectation is that the 10-year is what the market is looking for right now. Housing does need to suffer. It was overheated for a lot of the last 5 years, but it will suffer a little bit, and it is a bit natural, even though it's going to be painful. But the bigger problem is actually in the short end right now. And if you look at high yield bonds, um, we're expecting to see higher delinquency uh, and bankruptcies in the high yield market. And this largely has to do with rates being high for too long over the last 3 years. And a lot of these companies haven't been able to refinance their debt. So we're probably going to expect to see a long string of Toys R Us and Sears style bankruptcies, a lot of it in retail. But again, a lot of these companies have been zombie companies that haven't really produced anything other than raising capital through debt and continuing to pay off their debt with more debt. So part of this is good and natural, but if it's prolonged for too long, and if rates don't begin to come down this year, then we'll probably see a lot higher unemployment due to a lot of these small businesses and medium-sized businesses laying off staff, as well as bankruptcies. So a certain amount is healthy, a large amount is not. So going back to where we see rate cuts, I actually have an expectation that 25 basis points will come as early as July. It's also possible that we see two more by the end of the year. Now, that has more to do with my view of what rates should do. But if Trump gets his way and is allowed to fire Powell and bring in a new Fed chair, as Scott Bassett said today, then we might see a lot more aggressive rate cuts than I think it should go. So I don't agree with Trump that we should have 300 basis points of rate cuts. I believe that the right number is about 75 basis points. That way, we do have some natural defaults, some natural unemployment. The natural rate for unemployment is 5%. It's still below that. We do need to see some shifts in the economy for the economy to continue to grow stronger. So, what does that mean? I talked a lot about rate cuts. What that means is if we at least get 75 basis points of rate cuts, along with global monetary printing and rate cuts globally, I do expect to see risk assets as well as crypto assets rise through the rest of this year. So I've been a bit bearish over the summer in crypto, but I'm starting to come back around now that it looks like we have a long-term plan for rates, increased monetary printing. And by the way, if you look at global M2, Bitcoin should be at about 140,000 based on what the monetary supply looks like today. So I do expect to see a rally in Bitcoin again this year, and couple that with all the treasury companies that continue to buy Bitcoin onto their balance sheets, that should continue to send the price higher this year. Will we go back into a cycle, a 4-year cycle? Of course we will. So 2026 will likely to see lower Bitcoin prices, but this year we still have a lot more room to rally. All right. So that's great.
One quick thing I'll add on the uh, business failure front. We have seen a few very small regional banks and credit unions fail over the past couple weeks. It's not like sky is falling type stuff, but it's definitely something else that we are monitoring. And you see these announcements on Fridays because that's when the FDIC steps in and cleans up the bank for the weekend and then gets it ready to go by Monday. But nothing as bad as what we saw in 2023, but we are starting to see a little bit of that on the fringes.
Yep, that's right. All right. Inflation. Well, inflation can't stay at 2% forever. But I do expect inflation to continue to stay muted, primarily because of two things. One is used autos. People just simply can't afford to buy cars. So whether it's used or new. So you may have noticed in the news that interest rates on new purchases are as low as 0.99%, which is much lower than the risk rate. This means that auto manufacturers are getting nervous about their supply, and they're giving additional incentives through interest rate cuts on lending to get people to buy cars. Those don't apply to used cars, of course. You're still paying a very high interest rate if you can afford it at all. So the used car market, which is a big driver in CPI will likely come down, as well as housing. Apartments are coming down in price, even in hot areas, as well as other types of housing. This is what's used for CPI calculation. So those two factors alone should really drive it. There was a scare that oil production would be muted due to Iran, but the U.S. is allowing Iran to continue to sell oil to China. So oil prices should stay fairly muted as well and not be a significant factor in driving inflation. So I do expect inflation to stay between that 2 to 3% area, if not go lower, which shouldn't cause the Fed any grief. And then as far as the curve goes, I mentioned this before. We do have a bit more of a normal twos, tens. I would like to see it steepen a little bit, but look, as long as unemployment stays below 5%, we probably will see the curve continue the way it is. Um, and then of course, GDP. So we actually expect the GDP to continue to grow, even though there was a negative print. That is typical given the growth in Q1. So we do expect GDP to continue to be at about 2%, 3%, which really should continue to drive equities a bit higher. And then, of course, debt. There is a problem with debt in the US, not just at the government level. By the way, the big beautiful bill is set to create a lot more debt for the US and a lot more spending, which is the opposite of what I had hoped, even though my expectation was that it doesn't matter what political party you are, you want to spend money because the people that pay you to be in office expect that. So even Trump said it in a tweet over the weekend that you've got to get reelected. Don't try to don't try to cut money. I mean, don't try to cut spending too much. So as much as we would all like for the government to balance its budget, it's not going to happen regardless of what administration is there. There's simply no incentives to cut debt, which is a problem, but it's also an opportunity for us, particularly if you're a Bitcoin hodler and a Bitcoin investor. So it will continue to cause Bitcoin to go up.
Another thing I'll add is the strategic debt maturity issuance. They gave Yellen a hard time. The other side of the aisle gave Yellen a hard time for issuing so much on the short end. Bessent comes in and realizes if he issued enough on the long end as that maybe they should be doing, that would push yields even higher. And even today, Bessent has said, why would they issue rates on the long end today if they think rates are coming down? Uh, so this continues to be a theme that they being whoever's in power is issuing a lot more on the shorter end, more reminiscent of like emerging markets versus a U.S. historical norm debt mix.
Great. And finally, dollar weakness. Um, we do, based on the pattern from the last Trump administration, we do expect the dollar to continue to be weak, which there's a lot of other currencies that are even more weak right now, including the won and the yen. I got to experience that being Korea and Japan over the last 2 weeks. Everything was basically on sale by about 20 to 30%. But the dollar does continue to be weak. Now, what does this mean for exports and imports? Dollar weakness is actually good for it should help our manufacturing segments, which something that Trump cares a lot about. I definitely see policy that will drive dollar weakness in the coming administration. And finally, global liquidity. Not just money printing, not just interest rates lowering, but also the velocity of money continues to go up. So as global liquidity continues to rise, we do expect the price of Bitcoin to continue to go up. And again, the number that I'm looking at is about 140,000 Bitcoin, given the present condition. Josh, any different thoughts there?
No, I'd agree. And all this macro stuff, it's like if you take a fish tank, and the United States is a fish tank, and we're measuring the ammonia, the oxygen, how many fish are in the tank, all of the slides we just covered are basically saying the same thing, which is this singular indicator, at least US liquidity, global liquidity, all that is headed up and to the right. No matter how you try to slice it, everything we're trying to do is liquidity positive and should be positive for risk assets, as Stephen has mentioned.
Yeah. All
So I
right.
will, oh, go ahead.
Yeah. Well, I was going to say, and I'll turn it over to Josh. Thank you, Josh.
Thanks, Stephen. Uh, we do these monthly, and we tend to, at least I tend to have a shorter term outlook, but I thought it'd be important to look at the 1 and 5 year look back periods. Bitcoin versus gold, S&P, Qs, ag. This is important, obviously, in the 60/40 traditional portfolio mix. There's been a lot of talk, not just recently, but even in 2020 onward, about what is the correct portfolio outside of what we've seen traditionally, especially with the long end um, not doing so hot, right? So, if you're curious on further numbers, shoot me an email and I can cook something up for you as far as rebalancing quarterly, rebalancing yearly, having various percentages of Bitcoin in the 60/40. But this is kind of the whole ball of wax, right? Like, pick any time period you want, and Bitcoin has done very, very well against everything. And I think one thing that stuck out to me too, even zooming out, looking at NASDAQ versus the S&P, because of the concentration there of the Mag 7, there really isn't that much differentiation. I mean, there's a little bit, sure, the farther you go out, but at the end of the day, you kind of need something different, I think, in the risk mix. Rick Edelman, who's a big RIA, just put out a white paper about wanting a 40% allocation to crypto for younger folks. BlackRock has talked about a 1% BTC mix. I just think it's important for most people to get off zero at any price, and not because I just want somebody to buy my bags, but again, we're looking at the data, right? We've been here for a decade, and this is what we've seen, and this is very positive for BTC. Now, the future doesn't predict, or sorry, the past doesn't predict the future, right? But uh, so far, so good. One other quick note on this chart, we started the digital fund in January 2023. So we have a little, we have a little experience with market timing from that front as far as where we started the fund and why. Uh, so we're certainly very, very attentive to what this cycle could look like, obviously. Looking at monthly seasonality, last month we were talking about how June was kind of historically red, not positive, right? Not even if it was positive, it probably wouldn't be something enormous, right? That's basically what we saw. We were, at least I think as of today, maybe somewhere around flat, depending on how we close the day, June 30th. But July, on the other hand, outside of October, is the second best month, along with January, since COVID. A lot of this seasonality has shifted post 2020. I think that's because of what we've seen in the US liquidity front with the QE explosion and stimulus. But just looking at this, if you're looking at probabilities and you say, okay, what do we got? We got a liquidity tailwind, we've got a seasonality tailwind, we've got a few more tailwinds I'll talk about here. I think it makes a lot of sense to be aggressively risk on in the moment here for July. August, September, by the way, historically not as positive, likely because July is very positive. And if you're curious about legacy markets, legacy also has a very positive July historically, which makes sense. We're all in the same bucket here at this point. Looking at the cycle, we are 950 days from the low in 2022. We were tracking the 2018 and 2015 periods pretty closely. We've deviated quite a bit here. Uh, that's one takeaway. The second takeaway is if this looks anything like the previous cycles, we have about potentially 100 to 150 days left to get really going here. And the last takeaway would just be if this looks anything like, 2017, then we tend to kick on the afterburners here in the back half of the last year of the cycle, right? Which would be coming up here July onwards. And again, if we're thinking about positioning around seasonality specifically, put on the gas in July, maybe take some risk off the table for August, September, get ready to reallocate in a big way. Should that be appropriate sometime at the end of September to get ready for October? ETF flows have picked up on BTC in a big, big way. It's hard for me to really gauge how public this is just because I'm in it every day and I'm always looking at this stuff. But I don't see too much media talking about just the crazy amount of inflows we're seeing mainly on IBIT, but they're still getting, despite price being sort of flat over the past month, right? We're seeing just billions and billions of flows on a weekly basis. So that either means somebody else is selling more to for price to be where it's at, or there's other sort of financial engineering going on here with the basis trade or some net trading that's going on right behind the scenes that is taking advantage of the ETFs for exposure. But in any case, flows here are off the charts for especially a new ETF, a new asset class, crypto, right? And it's very underowned. If you talk to most legacy people, they sort of, shoo you away when you're talking about crypto, but we're seeing a lot of activity there on the ETF front. ETH, not as much, especially not, on a head-to-head basis compared to BTC. Relative to its market cap, it's doing fairly well for flows. We still don't have staking. We still don't have in kind. When we see those two things come to the market, I'd expect flows to pick up in a big, big way for everything. At least initially, that's going to mess up all the on-chain data as well because we're going to see Bitcoiners who've been holding, transferring coins to the ETFs. And similar to the GPTC transition, it's definitely going to be a transition period where everything's going to look very strange on chain because my guess is you're going to have a lot of people sending their BTC to the ETFs. And if we just isolate IBIT here, IBIT was the fastest ETF ever to reach 70 billion AUM. And you can see the competitors there, GLD, which is gold, some other global market indices, it's not even close. So clearly there was some sort of demand that was pent up for whatever reason over the past decade trying to get this stuff through. And maybe it was a little bit of the forbidden fruit where people were like, okay, and we finally have this, let's do it. And it's just interesting to look back where we came from. There's a quote from Satoshi. It might make sense to get some just in case it catches on, right? And I think there's a little bit of FOMO for people, obviously, since the ETFs have launched. And most of those people, I'd imagine, are not short-term investors. They're longer-term investors who have been looking at this stuff, looking at the data, and realizing, okay, it makes sense to allocate something. As far as positioning, again, putting on like the trading hat, looking at positioning and funding specifically in the futures markets for BTC, ETH, Solana still remains very, very muted to negative, which is unusual considering BTC's up here essentially consolidating at all-time highs. That's not what this chart shows, though. This is positioning from the CME futures data. And if we look at just the red bars there, um, basically this positioning favors bullish continuation because you've got a lot of people off sides on the large speculators bucket. If you look at the COT data, it separates out who's who. And then we back test this, you match this with what we've seen for price action. And this is what you want to see for positioning. You want to see funding negative to flat. There's not a lot of euphoria on the leverage side. There's certainly the flows on the spot side. And then futures positioning looks like this. And that's very, very bullish historically when we see a picture like this. We also have ETH here, not it's the same, but similar. It's a very favorable futures positioning for ETH. And it is interesting now that we have multiple years of this data that we can actually look and see, does it matter? Does it backtest well? And it does. So you can see also on ETH here, just the red bars again. Historically, we haven't seen a very strong continuation on the commercials, not not for an extended period of time. So it'll be interesting on how long this can hold. And again, you'll notice like ETH is down, I don't know, 60% year to date or something, 40 to 60, something like that. And most of 2025, again, red bars were net short. So that lines up with what we've seen and what you'd expect based on that positioning, right? Looking at BTC price action here since January, December, a lot of people are sort of getting anxious. They're like, oh, volatility for BTC has dropped to basically match the S&P over the past 2 months here. And from a technical perspective, what you tend to see is a lot of activity and then consolidation, a lot of activity and then consolidation. As you're consolidating, you can make a decision based on what you see using technical analysis. Do we think this is a bullish consolidation, a bearish consolidation? Do we think it's continuation in this case? Do you think it's a reversal in a bearish case? This setup is certainly more reminiscent of a cup and handle at this point, which is just a garden variety bullish continuation signal. I will add, you're seeing this on legacy. You're seeing this all over things like IWM. You're seeing this on Dell. You're seeing this on Rocket Lab. A lot of the legacy stuff has already moved with similar patterns, and it makes sense that and if Bitcoin's in the risk on bucket, we all kind of look the same. So when Stephen was mentioning 140, that's certainly in the wheelhouse. We've got a yearly pivot at 150. I think it would be tough for us to go that high in a month. uh, but none of this is bearish, right? That's the takeaway here. This is certainly a lot less bearish than it was going into June. So we're still very positive on near-term outlook, medium-term outlook for BTC. We're also in this trend channel since 2022. Again, just garden variety. What do you see here? It is up and to the right, and we can assign various support resist levels, measuring this same story. We get a similar resistance level that we got in March 24, in December, January 24, 25. So it wouldn't be unreasonable to see that. And something else a lot of people have noticed is we're not really getting these like boom bust moves that we have prior to the ETFs. And there's been a lot of commentary around the maturation of BTC as an asset, the maturation of the individuals trading this, right? Not only has the asset itself gotten older, but the people trading it have gotten older generationally. And I think they've matured a little bit. There's a lot of people in the altcoin market, maybe a younger crowd, more retail driven crowd, right? And I think that is also driving what we're seeing price action here. We're seeing a lot less just like, turbo volatility relative to what we see in altcoins. Trend metrics also very important dynamic of the fund and what we watch here at Canary. We're above the Ichimoku cloud. This is exactly what you want to see. Bullish TK cross, the blue red lines there, bullish cloud, the green blob on the right, and price above everything is the perfect mix for bullish continuation. And yeah, just, we can just check off the tailwinds. We've got XYZ. It's hard to bet against that. It's hard to be short. It's hard to position to the opposite side. Like, I wish you luck, but this is the picture where you'd expect continuation. Of course, that can be wrong, but if you're looking at probabilities, this is a very favorable outlook for a higher move here eventually in the back half of the year. Looking at other metrics around BTC, we have MSTR, which is in a similar consolidation period since November. MSTR broke out pre-election before BTC did in 2024. We may start to see that again here. This picture, again, none of this looks bearish to me as a technical analyst. It all looks favorable for bullish continuation. You have a pretty clear resistance level. You have the trend channel on your side. We aren't overheated from a channel perspective if we think about overbought on the bottom, oversold, sorry, overbought on the top, oversold on the bottom. We're in the middle. So this gives us room to go, regardless of anyone's opinion on MNAV or all the other treasury companies. This in a vacuum looks very favorable for continuation as well. I think it's actually somewhere closer to 400 today, but uh, that 420 level would be where I would expect a reaction from the market. Just looking at specific resistance coming up here. And again, if we start to see MSTR take off, that's favorable for Sailor buying more BTC, tapping the ATM, et cetera, et cetera. So we'll see if we see that, but it's definitely an interesting signal to keep watching. And as far as altcoins, it's been rough because they haven't really panned out how you'd expect, considering how bullish BTC has been. Even considering correlations here, if we look at Total 2, which is an altcoin index, excluding BTC, relative to Coinbase, which is coin, obviously, historically, since the coin IPO, these have been fairly tight on the correlation. You can just visually see that. Recently, the alligator jaws have opened up a little bit. So the question is Coinbase going to come back to earth, or are altcoins eventually going to catch up here? Is it going to take a catalyst? Is it going to take BBB? Is it going to take the Genius Act? Is it going to take a market structure framework bill? Is it going to take some of these products getting approved if and when we see that? I don't know. But again, it's hard to think that this isn't going to snap shut, as in alts are going to see something here to come closer to what we've seen on Coinbase. Similar example with ETH versus the Russell 2000, and taking it out of what this is and looking at what it's trading like. If it's trading like risk on sentiment, then it really makes sense if everything's risk on and ETH is Russell 2000, that ETH would eventually catch up here to strengthen the Russell 2000. So again, I don't know what that's going to take from a catalyst perspective, but we have plenty of upcoming catalysts here in the US at least to help push this higher and realign with the Russell 2000 chart. Yeah. So definitely just two comparisons to continue to watch here in the next couple weeks. And lastly, if we just isolate alts against Bitcoin, now that you're all cloud experts, you should be able to tell me that this is not a favorable trend for alts relative to BTC broadly. This continues to be very bearish and doesn't make sense to allocate into alts if you're looking at a chart that looks like this. Again, in a vacuum, there's what something is and how it trades, and alts collectively are not trading like BTC beta here. You really have a few ways to outperform BTC. You can either use leverage, you can use beta products, altcoins, MSTR, miners, or you can hope to outperform in a down market, in a bear market. Alts have not been a great hedge for trying to outperform BTC. They just haven't collectively done well. Another way to optimistically look at this as well, everything's reset. All the froth from the stimulus of COVID has fully reset at this point. And maybe, just maybe, we'll start to see something at the back half of the year. But this is definitely an important metric we look at when determining fund allocation to alts. Like, again, if you think about like legacy markets, you've got Mag 7 and you've got everything else. If Mag 7 relative to everything else look like this, which it does, by the way, if you look at QQQ relative to IWM, for example, IWM is just as weak as this chart relative to QQQ. So if things start to turn around, maybe it's rates, maybe it's something else. Possibly alts can start to do well in the back half of the year, but we certainly don't see that on the chart just yet. So that concludes our June webinar for now. Thanks for attending. Thanks for listening on the recording. This is our manager of client services contact, should you want to talk to us about anything. We also had two questions that were asked. So I will, if you have any comments or questions, let us know here before we shove off, but two quick questions. The first question, how will the future look between traditional finance and cryptocurrencies? So just today, actually, we saw Robinhood make an announcement about tokenizing stocks. I believe Kraken is also involved in that. And we're going to continue to see the lines get blurred between the, what is it, 9 to 5, 5 days a week of legacy trading versus 24/7 crypto. You're going to see more crypto trading on legacy rails. You're going to see more stocks trading on crypto rails with tokenization, and that's going to be 24/7. That's going to be global. It's interesting that I think both Robinhood and Kraken have introduced this tokenized stock market, where, but it's not available to US investors for legal reasons. Very interesting. Uh, Good news is US investors have plenty of ways to access US markets, whereas the non-US individuals have a harder time accessing US markets. So as silly as it's set up, it's actually probably for the best initially that it's set up like this, because those are the people outside the US that have the hardest time actually trading legacy products. Second question here, do you believe the SEC should allow crypto ETF in-kind redemptions? Yes, no. Um, Whether or not they should or shouldn't, we think they have a good shot, depending on what the market framework bill looks like, at allowing in-kind transfers, allowing staking, that sort of thing. And again, hitting it back to the first question, a lot of what we see in crypto is going to merge with legacy, and it's all just going to be in the same bucket slowly here. It's going to take a few years, it's going to take a while, but you're definitely going to start to see even Schwab, which we talked about last month, is talking about listing crypto directly, just getting rid of bypassing ETFs, bypassing anything, right? You're going to see a lot of that. You're going to see a lot of basket products with like a Coinbase top 50 or like an altcoin bucket, equal weighted, market cap weighted. You're going to see smart beta products. You're already seeing a ton of uh, income products around options. So we're going to see more and more of that as we go along here into 2026. Amber, was there any other?
Yeah, we just had another question come through.
Sure.
What is your estimated probability of alts being permanently dead?
It's tough because BTC is a solid use case, solid narrative. It's been around the longest. It's easiest to explain. Alts as a group are all sort of competing for the same individuals, the same eyeballs, the same dollars. They are in direct competition with each other, and there are many of them. Even when you talk to legacy folks, it's harder for them to wrap their mind around things like Ethereum, things like staking. I think education is going to be a big part of that. Media is going to be a big part of that, because they're going to start talking about this markets framework bill and what that means. We just had a lot of people at every conference globally talking about stablecoins, in legacy and government. That's been going on for years. At this point, I think if you polled 10 random people in TradFi, they would all know what stablecoins are. So regulations helped, media helped, general education helped. I think we're going to need the same type of lift to try to get people on board with understanding what are altcoins, what do they do, who are they for, who's their audience, why should you invest in this stuff. So I don't know about dead, but there's always going to be a time to trade something. That might be the last wave of the current cycle, which could be if, for instance, we drop rates significantly, if we do some sort of stimulus, if we uh, move from QT to QE. I can imagine a world where altcoins as a group, similar to the IWM chart, right? They just do really well in that environment when we have very loose conditions for risk off sentiment, right? It favors riskier investing behaviors. We will end it there. And thanks for everybody. We'll see you next month.